Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:19 a.m. Central Time, and I'm recording this in preparation for the market day, September the 23rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, a little bit of action, and indeed we've got Draghi, the European official, getting ready to speak in just a few minutes. Let's take a look and see what we're dealing with at this point. The four U.S. broad market indices are all positive, with the S&P and the Dow essentially scratch. Russell the most bullish at about 0.5% up, and the NASDAQ up about 0.2%. Crude oil up about 0.75%. Euro up about 0.25%. Bonds down about 0.33%, and gold up about 0.5%. In overseas action, China, I understand, had another miss on their manufacturing, the poorest rating in some 6 years or so. They're down at the time of this cut about 2.2%. Hong Kong down about 2.25%. Japan down about 2%. Germany, with Europe, a little bit different picture. Germany's up about 1%. United Kingdom's up about 1.75%. In terms of macroeconomic reports for today in the United States, you have flash manufacturing PMI and crude oil inventories if you are a trader in that market. FOMC member Lockhart once again speaks. He is on quite a trip, it would seem, this week, speaking almost every day of this week, it seems. In terms of tomorrow, you have core durable goods, unemployment claims, the weekly variety, and durable goods orders, new home sales, and natural gas storage. And you had the big one, Fed Chair Yellen speaking, but that will be after the market closes tomorrow, so be aware of that for overnight action. In terms of market conditions, current volatility conditions, we did have standard deviation moves put across all four broad market indices yesterday, and it was a pretty ugly picture, really, with a breakdown of the recent pattern. And you notice, obviously, we've talked about where we had a breakout of the ascending triangle on the S&P. That was a post-Fed announcement. Of course, immediate reversal and a very bearish candle there, met with confirmation and then a break of the diagonal support. A bit of a bounce, but still closing below that diagonal support, then follow through to the downside yesterday. And yesterday's action, as I have this drawn, bounced off near a fib area. If you draw the fib retracement a little bit differently, without this wick here, you also get a very interesting potential bounce point right down here. You see this candle here, and the bottom here, that's about 1903, and obviously you got the round number 1900, and then the third point is that there would be about a 618 fib retracement if you draw based on this pattern here. So if we continue to have any weakness, that's probably the next likely target, with the anticipation that you might see something of a bounce at that point, and then perhaps maybe another flag, and then down to the ultimate target, probably in the area of this swing bottom here. So that seems to be profile A for the charts at this point. Obviously, anytime new information comes in, it could take it off in a new direction, but that's the bias at this point. In terms of the Russell, very much the same profile. Really, all four indices are pretty much marching in relative lockstep with each other at this point. NASDAQ was more bullish going into this breakdown, but you see 3 dojis in a row with gaps. as for the opens on those. And then the Dow very much like the S&P. So pretty interesting patterns right now, but clearly quite bearish. And indeed, let's go ahead and go to the daily report. Some changes here from yesterday, not a lot. In terms of our primary market posture opinions, we're still phase 2 trend breaking. IBD status remains uptrend under pressure. Accumulation distribution for the S&P a D-, NASDAQ an E. GMI index remains a 0 out of 6 with a sell signal since August the 24th, and that author remains in cash. Primary market condition, strong bear. Stock charts did have an update. You had a short-term sell signal fire on the NASDAQ 100 version. So when you put all this together, all these down arrows across the different time frames, the various other metrics that we use to take a look at portfolio investment posture, consensus opinion being really decidedly quite bearish, and not a lot of bullish signs to point there. And intermediate term market posture has flipped to very bearish with yesterday's action. Indeed, the S&P below a 50 and bearish, 42.9. The let's see, the Russell also very bearish at a 46.9. So 42.9 for the S&P, 46.9 for the Russell, both below the 50 line, very bearish. And then you have the Dow holding on to just simply bearish at a 50.9, though that would go very bearish if it drops below 50. NASDAQ overall relatively the strongest, and we could call this actually bearish as well, as it's still above the 50 line but pointed down. So that was one of the things that was kind of in recent days holding up a little bit and giving some hope to the bulls, and that has now flipped. Overall hedge warning status, the risk level currently is level 2 or red light. So very, very cautious trading conditions, especially for novice traders out there at this time. Remember that this is an assessment of the level of risk in the market. It is not a prediction of how far a market might fall or how fast it might fall, but that conditions are ripe for a elevated risk and are certainly enhanced for the downside. In terms of the individual metrics, volatility base, market in decline, and sharp increase warning have fired. VIX is still over an 18. Distribution count is at 4 now, with both the S&P and the NASDAQ at a 4. And we hit 5 on this, and that will become its own warning level. But in the meantime, I would just simply mention that this has gone from a reset of the count when IBD went to confirmed uptrend for the 1 day before failure back to uptrend under pressure. This count reset at that point, and we have gone from 0 back to 4 in really quick order, and one more down distribution day, and we would have a warning sign on that level as well. Skew again over 135 back-to-back days. That does have the potential risk of a multi-standard deviation move to the downside, so keep that in mind. In terms of new highs, new lows yesterday, not quite to warning status at 300, but clearly you look at the ratio here between new highs at 42 and new lows at 287, decidedly bearish there as well. In terms of the intermarket risk aversion indicators, we have now 4 at risk off and only 1 at risk on, and it was curling over. So again, another bearish sign. In terms of special opinions, option income strategies, VIX remains outside the acceptable window. I had a question about this. And one of the things to keep in mind is what we're defining here with this opinion is, when option income strategies are perhaps easiest to trade, and that is to say that the VIX is between a 12 and an 18. You're able to put stuff on and oftentimes just leave it there and eventually take it off at your profit target. Now, for novice traders, that's kind of the ideal range. Now, more aggressive traders actually look forward to these higher volatility levels because they can get more premium. But at the same time, it does require significantly more capabilities and skills around the ability to adjust. Obviously, you have, with that increased volatility, increased risk of significant delta moves and, of course, significant vega moves, which would create situations where you might have to do a lot more adjustments. Now, and also might require a lot more trading capital to make those adjustments. So it's an opinion that's dynamically focused on the typical option income trader. If you're an advanced trader, then obviously all these opinions get nuanced between novice and more advanced traders. You might find this is ideal for you. Covered call strategies and put selling. Conditions are borderline in both of those areas in terms of initiating new positions for novice traders. Aggressive traders might consider reduced position size, scaling in, using defined risk strategies, or with the case of covered calls, legging into that position by selling puts, and then if assigned, converting into the covered call strategy. So very, very conservative postures right now on both of these, and this is all, of course, in context with all this that we are seeing from the various metrics above, including this most important overall portfolio investor postures being decidedly really quite bearish. So very difficult to initiate and do well in this current market environment in terms of selling puts against core portfolio type positions, doing covered calls and the like, or just kind of run-of-the-mill milquetoast type option income strategies. Now, more advanced traders, of course, can be more nimble and work around that, but will also be more prepared to address stress. Now, at some point, we're going to have to become active in terms of the bearish swing trades and so forth. But part of the problem with going with that stance as of yet, while we are in the posture in the short term, intermediate term, and even to the long term relatively bearish at this point, we've not actually set into a real pattern of just outright bears. Well, the bulls clearly have been making noises at times about regaining this, and not quite at that point where we're comfortable and just setting up a predominant number of bearish trades. And frankly, in my own trading, mostly what I've been doing is selling like SPX bear calls and buying puts, and then taking quick exits when I get a move like yesterday. I literally exited my puts in this last batch, literally near the bottom of the day yesterday, and was very happy to have gotten that trade and taken that off. These were relatively short duration puts. They expired in 8 days, so I got the pop I was looking for. You take your profits and then you look to reset. If we get another pop up and continue with this consolidation pattern, if I were to see this action come back up in here, I'd be frankly more inclined to buy some more puts and look for the next pop down and basically reset and go again. So that's primarily what I've been looking for, as opposed to bearish swing trades, and where I might do something on Netflix or Priceline or something like that, and looking for kind of a days to weeks kind of pattern. It's very difficult to see days to weeks forward at this point. While our first hypothesis is that we're likely to visit this area, that could happen in 2 days, and then in the meantime, I would expect that there would be perhaps a bounce at this 1900 level before ultimately going down to this 1866 level. So just some mixed news there, mixed expectations, and that's part of trading. It's part of real world what happens, but keeping the duration of trades very opportunistic at this point. is kind of the posture that we're taking. Sector market posture, you see here, as expected, we talked about this with the open yesterday, that if we saw that follow through, we would likely see all this turn red, and indeed virtually all red, all time frames, all sectors at this point. Also, you see the percent change, very negative, especially for everything but healthcare. Healthcare held up relatively the best. They already had taken a beating the day before with the biologics, especially taking a hit from the Hillary Clinton attack on that industry. Obviously, also in context, we keep looking at this 1 day, 5 day, 1 month, 3 month, year to date, even 1 year. A sea of red here. If you needed any more reinforcement as to just how weak follow through is for the bulls right now, you should take a good close look at these two graphs, and that should be quite convincing. That should be enough for today. As always, if you find what you're getting here is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers, like us on YouTube, subscribe to us to our YouTube channel. Direct email support can be sent to support@falconglobaltraders.com. More information is available at this website about what we do and how we actually put these principles into our trading. And then free trials are available. And disclaimers, as always. Hit the pause button if you need more time to review the disclaimers. And we'll look forward to seeing you back here tomorrow morning before the market opens with the market preview from Falcon Global. Good trading.